Time now to talk business thanks to our partners Forsyth Barr. The US economy is shedding jobs at a rapid rate just as higher fuel prices start to bite. So what's driving the forces? We'll look at those this morning. Herald Now business host Garth Bray is with us. We talk business every day thanks to our partners Forsyth Barr. Garth, good morning.
Good morning, Ryan.
So we were down, 92,000 jobs Feb?
Yeah, which is a huge turnaround on the 50k uplift they were expecting. So it was an ice bath, basically. The markets all had a bit of a freak out at that one, I think. It was just another little sign. I think I was talking to some people late last week who were saying the big picture is the war and the conflict, so it's kind of hard to see how little bits of data like this move the needle, but this one will have given things a bit of an extra nudge, you'd imagine. It's the steepest monthly drop since the pandemic, and I think the participation rate's around 62% at the moment now, so you're sort of seeing that. Part of that was due to some sort of strike action in the US that temporarily discounted about 30,000 jobs, but you're seeing about an average of 5,000 jobs a month taken out of the information services sector, 11k in that month. So this is basically the the IT AI hiring bubble sort of collapsing as perhaps some of those applications replace jobs, maybe, or at least that's a justification that businesses might be using. And that's all probably playing into some of the thinking that the Fed has to try and make with a rate call that it's got to make next week. It's basically got both of its targets under threat now, both the unemployment rate and the inflation rate with sticky stuff. Market seems to be thinking, if we chuck up a chart there's some expected inflation stuff that's come out of market data. That basically it's bad for the next 12 months, but beyond that, not so terrible. So maybe they're saying, look through the inflation impact that's coming from oil and so on, and maybe think a little bit more about how that jobs picture plays in, and perhaps think about cuts. I guess we'll get their take. We'll get some Fed comparisons this week.
All right, very good. I mean, same situation the world over, right? People who are already a bit hot on inflation, and then the central banks. Let's go to oil prices. Yeah. Well, we've done a big thing on this morning, but you've got an update for us on oil.
Well, Brent, so where were we? Brent, I think I've got the current chart there. It shows it was about 94. It peaked towards to come back to about 92. That was largely after the US Treasury Secretary gave a 30-day waiver to let Indian refiners buy Russian crude, especially if it's stranded at sea. So this is kind of some real sudden switching in the geopolitics here. But then at the same time, in the US, they said, no, we're not talking about releasing any of the strategic petroleum reserve stocks that they've got there. And there's obviously been quite a lot of increasing reports of cuts to production. Kuwait has said we're topping out the tanks, we can't store anything more on site, so we're going to cut back production. Saudis apparently are dropping back. You had, I think, the kingdoms of Saudi Arabia saying that it intercepted 21 drones attacking the Shayba oil field, which produces 1 million barrels a day. That's the first time an oil field, I think, has come under attack in Saudi in this time. So all of that putting the pressure on. But if we take, there's another wee chart there that looks at the oil shocks, which is this is more like the profile. The numbers not so much like, because obviously we're still at $90 a barrel and things were way up above that, but that's the pathway over the similar period between now and when this conflict started and when things kicked off in Ukraine and Russia. It's showing things are on a similar trajectory basically, even though the actual numbers we're talking about 90 versus what it was, $120 a barrel, I think it hit back then.
Yeah.
I guess they're looking for playbooks in the market. They're looking like, how quickly will we reverse this once some sort of normality kicks in, and how quickly can we look through all of these pressures to say things will be back to normal? And
from that sense, you almost want the Gulf states to get involved and start whacking back.
Well,
so they can just crush and decimate Iran, and then we can all move on and not pay so much at the pump.
Or to travel. In New Zealand, I think the share price dropped about 6.5% on close on Friday because they were looking at a massive exposure on jet fuel.
Yeah, plus they were already getting a hiding on their results anyway.
Yeah, well, yeah.
Hey, very quickly, some good news for businesses on the cost of insurance.
Yeah, nice piece from Junaid Tibshrani there in the Herald this morning, pointing out that commercial insurance premiums are expected to continue to drop. Sadly, this is not going to show up for mum and dad wanting to reinsure the house and so on, because reinsurance costs are a smaller component of that. So, but the reinsurance costs apparently dropping down a bit, and that means commercial stuff, professional indemnity, business interruption, commercial property insurance, because the market's been a bit softer, prices coming down. Let's see if that helps to feed through to some of that sort of sticky CPI figure.
All right, very good, Garth. Good to see you as always. Garth Bray, Herald Now Business. We talk business every day thanks to our partners Forsyth Barr.